Hello, folks. My name is Magnus Brandforce. I am a registered investment advisor with Commonwealth Financial Network. My office is in Stellicum, Washington. I have been licensed since George H. Bush, 1992. Today's video is going to be about turbulent markets, and it'll be the first in a series of videos that I make that discuss my business practice. 1994 was the first troubled market. It was based upon Alan Greenspan raising interest rates 8 times during the course of that year and causing pretty serious volatility in the stock market, but even worse in the bond market. And many investors in 1992, 1993 were dealing with low interest rates and had clamored for higher, safer yields. And many of them had plowed their money into government bond funds. Well, with 8 interest rate hikes, those bond funds did rather poorly. The next difficult market was in 1998, when Long-Term Capital Management, a large hedge fund, had gotten in so much trouble with derivatives based upon European debt that the Federal Reserve in the United States had to step in to alleviate the potential damage and risk that it was causing. After that, the well-known dot-com bubble finally burst in the first quarter of the year 2000, setting off a spiraling set of events that would lead to very tumultuous markets for about 3 years. In 2001, after the World Trade Center bombing and the war in Afghanistan, and then the build-up to the invasion of Iraq, along with a recession that was a hangover from the dot-com era, you had a perfect storm, and people saw the largest losses in even extremely well-diversified investment portfolios of 40 to 50%. Those were very challenging times, and at that time, most American investors of substantial means had not seen a major correction to that degree. It had a profound impact, that period of time, on the financial services industry. Upon the successful invasion of Iraq and the lack of casualties on the Allied side, the markets recovered, and the economy recovered, and a housing boom got underway and would eventually grow into a housing bubble, which would be remedied by the significant economic contractions of 2008 and 2009, which saw an extremely negative market throughout the world, in covering virtually all asset classes, whether it was bonds, stocks, or real estate. The recovery of 2010 was then met by an economic crisis in 2011. It was the European debt crisis. Since 2011 until 2020, the markets had been recovering relatively well, and growth stocks were starting to really take off, and we came into an unusual circumstance in the pandemic, the coronavirus pandemic. Toss in some rioting and looting and civil unrest, it has been a tumultuous year. The market sell-off in the spring created losses in reasonably diversified portfolios of as much as 30 or 40%. We saw a pretty big recovery as the body count didn't materialize to what the predictions had earlier stated. And the economic recovery since springtime has been fairly sharp. So here we are in September of 2020, and now we are coming upon the election. So I did want to talk about these turbulent markets. And the first rule about bad markets is be prepared for them. Bad markets, turbulent markets, for the most part, come after a fairly strong bull market. So going into being prepared for a bear market would be making sure that investors have enough cash in a bank or savings or checking account, money market account, so that they can reasonably cover expenses for possibly up to a year. They can, put aside money for their expenses, but also their cost of living for 6 to 12 months. By doing so, you can generally weather, even a fairly good storm. An investor should be careful, especially after a prolonged period of time of successful investment, pruning out sectors that have seen significant outperformance for a very long period of time. If a sector of a stock market has done well for well beyond 3 or 4 years, one should certainly be considering taking profits from that. Investors simultaneously should be saying, where's the value in the market? Value stocks compared to growth. Value stocks, dividend paying, larger companies, potentially undervalued. Maybe the price is significantly lower than it was 5 or 10 years ago. And buying in industries that may be out of favor. The stock market does cyclically rotate, industries. For example, 10 years ago, everybody loved oil stocks. Today, everybody hates them. And the price reflects that. Back then, they were, in hindsight, they were extremely overvalued. Today, one might argue that they are undervalued by measure of dividend yield, book value, earnings per shares, PE ratios, etc. So owning out-of-favor stocks in a bear market, one would think that if a stock's already gone down significantly, well, in a bear market, the air is out of the balloon already. So maybe the losses will be somewhat mitigated for that fact. And then to diversify, I could probably do a 1-hour video at least on diversification. I will address that subject in another video. But diversification is not just the number of investments you have, it is the type of investments, and it can be, in today's day and age of global investing and some very sophisticated financial instruments, diversification is a very big project. You're talking medium, large, small companies, domestic, international. In the international markets, it's developed nations, it's emerging nations, it's Europe, it's Latin America, it's Asia. There's the currency element of diversification. Then there's the bond market, there's real estate, there's precious metals. Today we even have cryptocurrency and Bitcoin. So diversification is a huge part of handling turbulent markets. The idea being that no matter how bad it gets, there should be at least something in your portfolio holding the ship upright. And even if everything does poorly, once the storm has passed, the quality of the portfolio that you have will rise, though there may be some long-term fatalities. Going into a bear market, sensing that there may be trouble on the horizon, or just being prudent and not always trying to go as fast as you can with your investment portfolio, you leave room to ramp up your prospects for growth and higher returns by being able to shift money into more growth-oriented investments or undervalued investments should a correction occur. So dialing it back a little bit. So there covers the first rule about bad markets. It is to be prepared for the storm. So once a bad market gets started, there are certain elements. At first, there's denial. The media will generally convince you that no, everything's fine. This is just a minor correction. Stay the course. That is often the case in the beginning of the trouble. Eventually, though, some sort of a guru will arise that will explain to everybody that this is bad. This is really bad. And they'll have some sort of credentials because, somewhere in the past, they were the guy that called it exactly right. And so they parade this person around, and this person will throw out a lot of facts and figures and new words and get everybody convinced that this is really bad. Worse yet, they'll say that, well, this time is a lot worse than last time. See, if they don't say that, you're not going to watch. So there's always this effort to try and get your attention, and there's this convincing that, yeah, investors in the past have always been protected by diversification and being patient and hanging in there and being optimistic. But this time, no, this time that's not going to work, and here is why. And they'll prattle off a lot of things that at that very moment sound really good. I mean, obviously back here in spring, we were being told by, for example, the governor of California that they were expecting about 1 to 2 million Californians to die from coronavirus. That sounded pretty bad. And, well, that made this time different because we hadn't heard that one since, I don't know, the swine flu epidemic 100 years earlier. So, and I don't know, governor of California sounded like a reasonable person to believe. And, well, in hindsight, he was wrong, thankfully. And so there were very dire predictions being made. So this time is worse is a powerful element. In the 2008-2009 downturn, for example, they said this time is worse because, and we're not going to have a V-shaped recovery. When things get better, it's going to take forever for this to recover because it's so bad. And they got people to believe that. They called it the impending L-shaped recovery. Certainly the economic situation between 2000 and 2002 was also a very new, real, horrible expectation, and it looked like the world may drift into a very bad global war, which it didn't quite pan out that way. Now, oftentimes, a bear market follows a very strong bull market. And the financial news media is slowly gaining attentions of viewers as the bull market grows because it's fun. It's fun to make money. People think that there's opportunity there to change their life. And so people start gravitating towards financial media. When things go bad, people are glued to the TV because it's interesting and it's scary. And people are being influenced greatly by this media channel. And unfortunately, it can play very much into the greed side as the market's going up to make you do irrational things that you wouldn't have done otherwise. Or it can make you lose faith in what you're doing as an investor and capitulate. And unfortunately, the financial news networks, whether this is intentional or an accident, it is so toxic that I can only recommend to change the channel and watch something else. It is not going to be particularly helpful for you. By the time you are full of panic, it's probably too late to do anything anyway. Each of these bear markets, and I've studied the bear markets before me going all the way back to the Civil War in the United States. There's always a logical explanation for what happened after the fact. And there are new words, new vocabulary for all this. And for example, it's amazing how quick people started to understand derivatives and collateralized mortgage obligations and sovereign debt and all these kinds of words in 2008 and 2009 as they, excessively listened to the financial news networks. So that brings us to survival. What does an investor do to get through a tough time in the markets? It goes back to the beginning where the first rule about bad markets is to be prepared for them, because your investment portfolio is like you going out to sea. In the middle of a storm, you're going to have to make do with your ship and your supplies and your crew, and you're going to have to batten down the hatches. The more you do in the middle of a storm, the more likely you are to make a mistake. Fear tends to make people do irrational things. So it's probably too late to do something with troublesome securities. The price of something may have very well gone down enough where at this point you may as well simply hang on to it and see if it recovers. A bear market, generally speaking, of all the bear markets that I've been through, only a couple of them have been really short-lived, say 6-9 months or less. They usually last a year or two. So it's much like the flu. You're going to get so sick, 15-20% downside to 50, and for so long, well, a year or two. For example, if you get sick, if you get too sick, as a person, you die. And if you're sick for too long, you die. Well, the market doesn't die. So it's only going to be sick to such a degree and for so long. It may kill some people. The idea is it shouldn't kill you. I'll go back to what I said earlier about the media. It may just simply be a good time to tune that stuff out and find something better to do with your time. Walk the dog, exercise, watch the Food Channel on TV, crossword puzzles, jigsaw puzzles, reconnect with old friends, go camping. But watching TV all day and fretting about the fate of the world is probably not going to do much for your investment portfolio and might just make your hair turn gray or grayer. Now, there's also no law about you having to open the statements that are mailed to you every month. You don't have to watch your investment portfolio every day. Do you check with an appraisal company to see what your house is worth every day or every week or every month? No. Your investment portfolio is no different than your house. The value of it should go up over time, but it's going to have its good days and its bad days. So excessively following investments is not the trait of a very good investor. It's actually the trait of poor investors. Now, eventually, a bear market gathers a tremendous amount of steam and starts getting carried away. And a person that does have cash or the ability to reposition the portfolio in a more aggressive manner, when is a good time to do something? It may be a good idea to do something once the market has made somewhat of an upswing. Now, if you wait until you feel better or people say it's better, the market opportunity will be gone. I've seen that in every one of these market scenarios. As the market recovers, the experts will tell you that it's too early, that this isn't a recovery, it's a fake move. It is very common to be hearing those kinds of comments. Also, the market goes up in anticipation of better events in the future, not necessarily today. So there are markets where the market is going straight up in the air after a long sell-off, but the economic news being released daily about unemployment or new hires or manufacturing, etc., are bleak, to say the best. But the market's looking past that. It's looking forward instead of at a present number. So, if you can't buy, either because you don't have a stomach for it or you don't have the cash to do so, better to sit tight and not make a bunch of wild changes with your investment portfolio. You know, it's such an important thing about the survival of bear markets or turbulent markets to be an optimist. And it's like, when the market's done poorly for a while, you should be an optimist because eventually things do turn around and get better. There's not a lot of money to be made in being a pessimist. And historically speaking, being an optimist has generally always served investors well, especially after a prolonged period of weakness. That's where the opportunities come from. The advice that I've talked about has basically, historically, always worked. And I have had times in the past where I've had to ask clients, I said, so if you want me to do something different, are you saying that you would like me to not do what has always worked, but to try something different that, well, has never worked? Nobody would do that. So that has usually dissuaded somebody from financial suicide when they've been stressed out and come speak with me. Doing the right thing generally works. But it requires patience. And I've had this discussion with clients over the years that patience, what is the definition of patience? Patience is a little bit longer than what you think you can handle. I've had clients say, well, all right, I'll be patient for a little bit longer here. I'll see how things are going in a week. It's probably not much is going to change in a week. Might not change much in the next 3 months, 9 months. It might take 24 months. If you're doing the right thing, you got to be patient. One time not to be patient is if you've done everything wrong. That's not going to be done here at my hands. So patience, that is a difficult one. Volatility and patience both are generally a little bit outside of the realm of even the strongest investors playing the game. So, with plenty of experience in terrible, horrible markets, and I've worked at brokerage firms and banks, and I at one time worked for the largest bank failure in United States history. And I survived that, and so did my clients. And they came with me here to Stellicum Investments. So what are the nuances of right now in this market? Obviously, this pandemic was an unusual twist of events for financial markets, and it was a global event. Also, the significant civil unrest. The NASDAQ bubble. The NASDAQ is a market index made primarily up of more growth-oriented investing that is disproportionately weighted towards technology stocks and healthcare-related stocks. The NASDAQ has been outperforming the broader financial markets of the world now for 5 years, but especially so in the last 12 months. And then, at the bottom of this pandemic, really took off. We've seen an incredible rise in prices of a handful of stocks that are disproportionately affecting the NASDAQ. And bottom line is, it's creating a market disparity. A properly invested, diversified investment portfolio today is greatly underperforming the performance of the NASDAQ. What this is doing is getting many investors to say, hey, I've got this diversified investment portfolio and I've been with it for years and it's not doing that great. But meanwhile, all of these interesting, companies are doing really well, and there's this NASDAQ here. What if I should just move my money from this, into this? I think that has become a big part of this market because during the dot-com bubble, a properly diversified portfolio was still doing pretty good. But the growth stocks and dot-com stocks did even better. And so there was some shifting of money from everything else, to that, but not quite to the degree of this market because, generally speaking, we've seen extremely bullish performance out of the NASDAQ and some pretty significant losses in other financial instruments. So there is all this money coming into the NASDAQ, and that is not just from United States investors. You better believe that investors in Asia, Latin America, Europe, etc., are also piling into these growth-oriented stocks. And it is causing what many describe to be a bubble. There are also a lot of people that were let go and lost their jobs and became unemployed during this pandemic. And I do wonder if many of these people have taken their spare time and their 401k savings and decided to day trade. And instead of owning a broadly diversified portfolio, they've cashed it all in and thrown money at some of their favorite stocks of the day, 3, 5, 10 stocks. So all of this money is chasing a small handful of stocks, driving the prices higher and higher. Worse yet, the people that got in relatively early on these investments don't want to sell. They want to make more money. There comes a point where a client makes so much money in a stock that they start becoming very sheepish and defensive about selling this magical bean that seems to be growing straight to the sky. So you can only imagine how fast the stock price goes up when nobody wants to sell. And we have been seeing that kind of market behavior now for the last year. This market has also shown a little bit of a new wrinkle. It's not totally new, but compared to my previous several decades in this business, the toxic environment of politics, the Trump lovers, the Trump haters, the Antifa, the BLM, the politics of what's going on today in the financial markets is making people do or not do things. Going back to the earlier days of my career, there had been 12 years of Reagan and then Bush, and now Clinton was going to take over. And the common wisdom back then was that the Reagan bull market was finished. People convinced themselves of that, and didn't happen. The Clinton years actually generated very positive rates of return for equities and fixed income. So politics and stock market are not nearly as connected as a lot of people think they are. Another example would be the incredible boom in oil stock prices under Obama. Obama was hardly a friend of fossil fuels, but oil stocks did incredibly well during the Obama administration. Much of it had to do with the fact that there was new technology for finding oil and refining it and for improvements there, and the demand for energy was high. And so it made for a very good market. So people should disconnect politics from their investing as much as they possibly can. This market is also now going to be heavily influenced by a coming election. I saw that coming into this year, and right now people are going to take a wait and see approach to the financial markets because there's this tumultuous event coming up here on November 3rd or 4th, and so there is a wait and see approach. In 2016, people did that leading in through the year, and about a month before the election happened, people started to bring money back into the market. But we have been through an incredibly chaotic period of time, in U.S. history right now, and we are more than likely now to see some sort of return back to order. If you look at the last 100 years, just pick a number out of the sky, and there's always chaos. Chaos is normal. In fact, if I look at the number of years that I've dealt with troubled markets, generally speaking, there's 2 good years, 1 bad year is what the average works out to be. So it's easy to get caught up in this idea that somehow today is so much worse than it's been in the past. It is. It's just different. So coming into this year, I decided to take a fairly conservative look on equities. I bought value stocks, kind of the conservative stocks. And unfortunately, they have languished this year while the NASDAQ stocks have done really well. But eventually things will turn themselves out. You know, the foreign markets, emerging markets have been relatively weak for a number of years. And I do see a great opportunity in the fact that other than the NASDAQ, most of the financial markets of the world today look unusually attractive. And so I think a very well diversified portfolio is going to bear fruit and pay dividends going forward. So I want to thank you for many years of being my client, or if you are a friend of a client, I thank you for watching, and I encourage you to stay optimistic because this too shall pass. Thank you.